What's going on, money lovers? Welcome back. So in the last video, we discussed selling put options and how I'm using this strategy to generate income. Today, I want to talk about covered calls and specifically selling covered calls on Tesla stock. If you enjoyed the video today, please don't forget to like, subscribe, and drop me a comment below. So I started making this little spreadsheet here to track my options income. So these are all the puts and calls that I sold yesterday, Monday, October 4th. So as you can see here, I have one put on Palantir stock, $20 strike price. I have two on SoFi at $15 strike. One's expiring November 5th, one on November 19th. And then I sold a Tesla $950 call. So $950 strike price expiring November 5th. So a month from today. And as you can see, that one netted me $396.32. So by far the highest value, and for a grand total of $618.64. So not bad, again, for a few clicks of the mouse. So let's look at calls on Tesla stock. So as you can see here, here's the call that I wrote, and I purposely went high because I don't want to lose my Tesla shares, but I would like to generate some income on it in the meantime, because why not? So I picked $950. You know, you can get more aggressive. I just want to put the least likely chance of these shares getting called away. Now today we're talking about covered calls. I would never sell a naked call or an uncovered call, meaning when you sell a covered call, you have 100 shares of the stock you're selling the call on. Options contracts are in 100 share increments. So when you buy one contract, you're buying a contract for 100 shares. If you sell one contract, it's 100 shares. So if we just take a look at the Tesla calls here, and again, as I said yesterday, you want to sell puts on days where stocks are in the red. So if I want to sell puts on Tesla, I would wait for a red day because the premiums will be higher. And as you can see here, and vice versa, when you're selling calls, you want to do it on a green day. And if we go down here, you can see the change in premium prices. They're going up pretty significantly because the stock is in the green today. So if we go up here, you can see already the option I had sold yesterday. So we're doing same expiration date, November 5th. Today it's up already 30 cents. So I could have made an extra $30 had I sold it today. That's okay. And as you can see here, if you did go a little lower, the premiums get significantly higher, but then you're running the risk of losing your shares or getting your shares called away. And when that happens, you would have to sell the shares. So let's say I had a $900 strike price. Tesla went over $900. Let's say it closed at $910. I still have to sell my shares at $900, but I do get to keep this $855 premium, because remember, $8.55 per share, so you're multiplying that by 100. So this covered call, if I were to sell it for with a $900 strike, would net me $855 in premium. So the downside with covered calls is if a stock does have a massive run up, let's say Tesla goes up to $1,000 and my strike price was $900, I still have to sell it at $900. But we're only looking a month out here. There's a November 5th expiration. If it goes above $900 before November 5th, but leading up to November 5th, it goes back below $900, then you're good. It only matters what the stock price is on that expiration date. And as you can see, if you want to be even safer, I could have went higher. $1,000 strike price would net me $222 in premium. So selling covered calls is a powerful strategy. You can use this with any stock that you own 100 shares on. I would not sell naked calls, because then what happens is, let's say I sold a naked call on Apple for $180, but I don't have the underlying shares. If Apple were to skyrocket up to $300, I would have to buy the shares at $300 and sell them at $180. So you're buying shares that you don't have at a higher price to sell them at a lower price. So I would never sell uncovered or naked calls. I would only use covered calls, meaning I own the underlying shares already. So then the worst thing that can happen is that you are forced to sell those 100 shares. But again, you have options. You can close these contracts out early. You can roll them to a further date. But just keep that in mind. And if it's a stock you don't actually want to sell, make sure you're going far enough out to reduce the risk of it getting called upon. And then on the other end of the spectrum here, we talked about this yesterday. I sold a $680 put on Tesla, which I actually closed out. So I made about $1,500 or 70% profit. And I had sold that contract for $2,093. So I closed it out early. I closed it out yesterday for expiration, and that's something I'll usually do when I'm up over 50% on an option contract. If you enjoyed this video, please don't forget to like, subscribe, leave me a comment below. Let me know if you have any questions, and let me know if you want to see more options videos in the future. There's a lot to talk about here. This is a great strategy that can help boost your income, help you, get a couple extra percentage point returns on your portfolio each month. There's a lot you can do here, and it's especially very good for when these stocks are trading sideways for so long, so you can earn some money in the meantime. This is Vinny from the Investment Club, and I'll see you next time.